This is an Uncovered Japan Company research report on ACOM, ticker 8572. ACOM is one of Japan's largest consumer finance groups, but the simple lender label misses the structure. It combines a volatile domestic loan book with high-margin credit guarantee and overseas businesses, while its affiliation with Mitsubishi UFJ provides a powerful funding advantage. We will examine that profit mix, the unusually strong balance sheet, and the two questions behind its below-book valuation. The report's market snapshot is as of June 2026, with ACOM near 447 yen. Forward earnings are valued at about 11 times. Price to book is 0.97 times. The dividend yield is about 4.9%, and the equity ratio is 44.5%. The stock is not priced for growth. It is priced for recurring provision noise, a mature domestic market, and the risk that a sector discount never disappears. ACOM traces its roots to 1936 and helped build Japan's modern unsecured loan market with its Mujin-kun unmanned contract machines. Today, customers can apply through kiosks, a smartphone-complete process, and call centers. The same underwriting and collection capability is reused in 4 businesses: ACOM-branded loans and cards, guarantees for partner bank card loans, overseas consumer finance led by Easy Buy in Thailand, and loan servicing. Underwriting is monetized twice, on ACOM's own book and as a service to banks. The segment mix is the key to understanding ACOM. In fiscal 2025, loans and credit cards produced 53% of revenue, but only an 8.3% operating margin. Credit guarantee produced 24% of revenue at a 31% margin, while overseas financial produced 21% at 29.6%. Those two specialty businesses supplied more operating profit than the much larger domestic loan book. ACOM is a volatile lender wrapped around 2 stable, high-return engines. Operating revenue increased every year from 262.2 billion yen in fiscal 2022 to 337.7 billion in fiscal 2026, a 5-year compound rate of 6.5%. Operating profit, however, swung from 34.8 billion to 100.4 billion. The main cause was not the operating business, but changes in the interest repayment provision, an accounting reserve for historic gray zone interest refund claims. The report therefore anchors normalized operating profit around 80 to 90 billion yen. ACOM's moat has 3 layers. First, MUFG-Bank owns roughly 40% and consolidates ACOM, supporting funding costs an independent lender cannot easily match. Second, decades of customer and repayment data feed an underwriting engine that ACOM uses on its own book and rents to partner banks through guarantees. Third, IR loan servicing keeps recovery expertise inside the group. The domestic loan product itself is mature. The durable advantage is the risk management infrastructure around it. For a lender, the balance sheet is the business, and ACOM is conservatively capitalized. Its equity ratio held near 44% for 5 years and reached 44.5% in fiscal 2026, compared with roughly 15% for listed rival Eiffel. That cushion keeps provision shocks from becoming solvency shocks. The double edge is efficiency. Excess equity depresses return on equity. Fiscal 2026 ROE reached 11.1%, but fiscal 2027 guidance returns toward 8.9%. ACOM's income profile is the richest in its listed peer set. The report compares a roughly 4.9% yield with about 2.5% for Eiffel and 2.2% for the TSE Prime average. Dividend guidance implies a 7th consecutive increase, including raises through years when provisions sharply reduced earnings. But investors should keep the distinction clear. Management's behavior has been progressive, while the written policy still promises stable continuous returns, rather than a formal, no-cut commitment. The next leg depends on 3 visible levers. Declining gray zone claims can reduce provision volatility. More bank partners and overseas expansion can let the 30% margin businesses outgrow the domestic core, and management can deploy an over-thick capital base through stronger returns, especially a buyback below book, a lever it has not recently used. Artificial intelligence is more opportunity than threat here, because better scoring and recovery models can deepen the value of ACOM's proprietary credit history. The clean valuation signal is book value, because provisions distort yearly earnings. The report's reference price of 447 yen sat below book value per share of 459 yen. On normalized net income of roughly 60 to 70 billion yen, the clean earnings multiple is ordinary rather than extreme. The re-rating question is whether ACOM can sustain 9 to 10% return on equity without a provision release tailwind, and whether management will stop excess capital from accumulating without purpose. These scenarios are assumption tests, not price targets or investment advice. From the report's 447 yen reference price, the fiscal 2029 bear case is about 380 yen, the base case 560 yen, and the bull case 720 yen. The range is deliberately wide because the provision remains an accounting estimate. The main downside risks are fresh top-ups, higher credit costs, funding pressure, regulation, overseas volatility, and a sector discount that simply persists. To conclude, ACOM is better understood as a fortress-capitalized credit platform than as a simple consumer lender. MUFG-backed funding, a rentable underwriting engine, 2 high-margin specialty businesses, and a rising dividend support the case. The trade-offs are a mature home market, provision-driven headline volatility, and an unused buyback lever. The 2 questions are clear. Do gray zone provisions finally normalize, and does management deploy excess capital? For the full evidence, assumptions, and source detail, continue with Uncover Japan's free deep dives. For a much deeper look, visit the free deep dives at uncoverjapan.com. We go beyond the headline numbers to cover the business, financials, valuation, risks, and catalysts. This video is for information and education only. It is not investment advice or a recommendation to buy or sell any security. Always do your own research.